holdouts in the market slide of the past year in technology, but now even mighty Cisco has fallen. We told you on Friday about the company's plans for big layoffs. Here's how it has traded over the last few trading days. Well, that's actually going back to 1996, so that's a pretty long-term chart, and you see the high that it hit in early 2000 at a peak of around $80 on a split-adjusted basis. We get a better look at that over the past year here, when you see the decline there, where today was down another 8+% to $18.83. The Wall Street Journal's Steve Frank joins us now with more. Steve?
Thanks very much, Bill. Cisco's close today actually puts it at its lowest level since November of 1998, meaning that if you bought this stock any time in the last 2 years and still own it, well, you've lost money. What's more, in that statement announcing job cuts on Friday, Cisco CEO John Chambers said he sees signs the slowdown is expanding beyond the United States, and that he now expects reduced rates of capital spending could persist beyond the next 2 quarters, in fact, beyond the end of this year. Joining us now with his thoughts on all this is Tom Lauria, who follows Cisco for ING Barings and who took down his own earnings estimates on the company today. Tom, good to see you. Thanks for being with us today.
Thank you, Steve.
This is a company that historically has delivered growth rates of anywhere between 30 and 50% per year. More recently, revenue growth closer to the 50% range. You just took down your numbers for this year to closer to the 30% range, and there's some reason to believe maybe they won't even make that.
I think it'll be a difficult environment. We're seeing, obviously, the U.S. economy in a bit of a slowdown, and as Cisco's seeing the slowdown outside the United States, that should make things even worse for the global macro environment. But then at the same time, we have carriers spending, and as well the CLEC issue, the competitive local exchange carriers, with the companies in that part of the carrier market having some reductions in their own opportunity. That'll obviously put less pressure on the incumbent carriers to drive spending.
To translate that into English, basically Cisco sells to companies and they sell to service providers and telecom companies. That business has slowed down dramatically. The company business has offset it, but you think that might not continue?
That's right. I think that the economy is impacting the ability for Cisco to grow its enterprise business, which that is really the lever that the company has. It's relatively dominant in the legal sense, and it really has the most leverage in that part of the business.
So let's talk growth rates. You're down at 30% now. How low could it actually go if things start to really worsen?
I think it's really unclear. I think with the company reducing its headcount on the order of 15% or so expected by the end of their fiscal year, I think we could certainly see revenue grow below the historic range and the official guidance and target growth range of 30 to 50%. So right now we're at about 30%. I certainly think that the company could see growth below 30% unfold in the next couple of quarters.
And what does that mean for the stock price? Recently, this company has traded at a price-to-earnings ratio that is a premium to its growth rate.
Right.
In the distant past, though, it traded at a discount to that growth rate. Do you think that could recur?
I think it's certainly possible, but I think that Cisco is still growing its revenues far in excess of its nearest competition, so it is certainly worth a bit of a premium. And I think when the market does rebound in the U.S. and as well outside the U.S., and the carrier markets improve somewhat, probably in mid to late 2002, I think that for the most part, Cisco will be in a very good position to capitalize on the growth.
In 20 seconds, what's the floor on the stock?
I'd like to believe it's not less than $15. But
I'd like to believe that, but you don't have a lot of confidence in that.
Well, I think, you know, that this is a very difficult market, and the company is still trading at a revenue multiple of about 6 times for our 2001 expected revenues. So I think if the outlook for revenues goes closer to 15% or even 10% for 01, I think we could probably get below that $15 mark.
Wow. Tom Lauria of ING Barings, thanks for joining us
Thanks
today.
so much.
Bill, back to you.
All right, Steve, thank you very much. Steve Frank.